Good morning and welcome to Markets Now. I'm Michelle Rook along with Scott Varilek with Kooima Varilek, and we're seeing lower prices except for the cattle complex this morning. And Scott, let's start off with cattle. Obviously, we have seen a little bit of a correction to start the week. We've had some lower cash trade, lower cutout values. But do you feel like this is a healthy correction overall?
I do, I guess. Thanks for having me. Healthy correction is good to use. You just don't really want to see them that steep or that swiftly, taking out some support and flushing lower, because we've got a market that's at some high prices, the record high prices. So when you start to break some support and flip, you've got a large sector of bullish traders, bullish producers. So there's a lot of open cattle, a lot of open risk that's on the market. And when you start to trade lower like that, suddenly it's, okay, you better get me some hedges on. You better chase into some protection. So you get some of that chasing that's got to happen just for producers to kind of protect themselves. You saw quite a bit of that yesterday. That was heavily noted in my end anyway. So that's going to add to some of the pressure, and it's going to have to be the feeders that are going to want to lead this market out of here. And the long-term fundamental story has not changed. We're still going to be tight on numbers. That's still going to be the case. That's what's going to hold us. When we do find a bottom, nobody's going to know how far we're going to break or what that bottom is. You hear a lot of different numbers out there. Right. We just got done trying to figure out how high this thing can go, and now we're trying to figure out how low it can go. So that's why you get the triple digit losses on a day and gains, because there's a lot of nerves packed into this market, and you did see a little bit of decrease in the open interest, so maybe some liquidation from some funds.
Well, it didn't help that we've had a lot of risk off mentality. First, the Fed and their announcement, but we continue to see these bank failures, and that kind of makes the market really nervous, doesn't it?
It just continues to keep us a little bit on the nervous side. You get some time behind you from when the last bank news happened, and then you hear another instance. So I think until we get far enough away from, we need some more confidence, I guess. If the government's going to say we're okay, things are fine, nobody really trusts it or believes it until we can say, hey, this is behind us. So we need to get some time behind us. I think it's just going to overhang the market for a little while. We've been at least dragging this out for a long enough period of time that I would think the American business system should start to say, hey, this is a little bit of an alarm. How are we sitting? Maybe we should look at ourselves. How are we doing? So maybe, if nothing else, that it's going to create a little growth that way as people really start to dive in and see what the health of their business is. But as far as these ag markets, we're going to stay nervous about it for a while, and going to need to see some extended confidence in some of these outside markets before we can start to put that behind us.
Yeah. So you still have a big discount with the futures to the cash, and cash has been leading the rally. And of course, softer week this week. But do you see cash trades starting to stabilize here next week, or when do you see that?
The packers are still interested in looking for cattle. They're still out. They're still driving through yards, and some packers driving through yards that they haven't been to in a long time. So the interest is still there from the packer wanting the cattle. We think the demand is on solid ground, and we still have a great grilling season ahead of us. The peak demand is still coming yet. So yes, the packer does want the cattle, but as fast as that cash rally, they don't want to let it get away from them. So until they start to show their cards, we may need to take another little push. They're going to try to keep the prices lower. The futures have stayed, a little bit more in line with what the Southern cash is. The North is getting a premium over the South, and it should be that way. We're going to get a choice select spread that's going to get a little wider, and they're going to have a need for some choice cattle for this demand run that we have. We're getting into a calf crop that doesn't have those long days on feed. So I think the supply of the choice starts to decrease a little bit as the old croppers are gone. So I think the demand is going to hold us on. The North should stay well premium to the South, in my opinion, just with the quality of cattle that we have. And the June futures can stay discount. That's a typical trade. I just don't want to jump in and say this June looks too cheap compared to cash. this May month of May here, we can keep that June discount until we get into June before it starts to realize maybe it does need to rally a little bit as we start to get more numbers in front of us. June's going to stay discount for a reason. And the Packers can use that. They can use that to get some cattle bought, put some basis deals out there, buy against that. See, look at the June boards at 162, and I'm giving you this price. That's a good deal, right? You're going to find a lot of producers that are going to fall into that and give some captive supply to the Packer. And that usually can kind of hurt us this time of year, the more cattle they get around them. Heard some instances from Packers giving a bid and saying, yeah, pick your week. What you pick, I'll take them as soon as I can, but what week works for you? And you can dabble out into June. So that tells me I think the Packers still looking for cattle, and they've got plenty of room. Big kill yesterday, but I think that they want to keep it that way. Their interest is there, but they're trying to keep these prices lower.
Yep, that's kind of what they try to do all the time. All right, hog market. We had a higher weekly close last week. We got the June above the 90 resistance area there and the chart patterns. And then we have a reversal. So this market you don't feel like is really ready for a longer term rally?
I don't think so yet. That's why we're seeing a producer that's struggling with some red ink, and there is talk of so much liquidation down the road that might help us later. It just doesn't help us in the upfront. When you hear that liquidation of sow herds, yes, that means they're going to go onto the market as well. We're talking about an increased supply in hogs quicker than I expected. It usually doesn't take that supply chain to really fill back up. And when you get those prices at 120 last year, that's incentive to really turn up the supply volume, and we did that. Now we're kind of on the other side of it to where we're going to start liquidating, and it does feel like we rallied $5 only so we can have a key reversal lower. We just can't keep a sustained rally under the hogs to keep it going. They don't have any leverage. There's just too much supply is what it sounds like. So you hear of empty barns, but still of no effect to the market there.
Yeah, and it's really disappointing when you have 49,000 metric ton export sales on the weekly report this morning, and the market even fades that,
Yeah, I think there's some money in the market. It's just not going to make it down to the producers here yet. They're going to be the last one, like I said, to try to get back into the green, and they're going to liquidate until that happens.
So grains are in the red this morning. And of course, we had the nice reversals yesterday, but not seeing a lot of follow through here today. So on the corn market, how much downside risk do you think we still have in this market? And should end users get priced at these levels or wait?
We've had a pretty good sized break, and now we're trying to figure out, yes, it can go lower. Does it have to? Not sure. If it gets below cost of production, yes, that can happen. It doesn't have to rally just because it's below what some of these costs are to produce that crop. So it still could have a little bit of a risk there. In the upfront, we don't have any major fundamental news to throw at it from the supply side. We're too early in the growing season. We're going to get it planted. So we've got another month before we start to decide what our weather patterns really are. So the easy path just stays to the downside. Now, if I'm an end user and I'm looking at this market, I'm going to say I just got done paying, X price for corn all winter long, which is much higher than what I can do some kind of protection for here now. So I could see an end user looking at this and saying, hey, we had that key reversal higher yesterday. We're taking about half of yesterday's move back today. So that's still intact. Yesterday's lows could be an important spot to watch for a little bit of a trigger point to see how strong this market's going to be.
Okay. And just quick on soybeans, again, no follow through there either, but we continue to stay above those March lows. We took them out yesterday, then closed back above them. Have you been surprised that we've been able to stay at these levels?
I'm not surprised that it's holding as strong as it is. I guess it's still so early to tell. The beans are the wild card, the one that moves the most and has a lot of volatility, and it's got a trader that fits that kind of movement. So I don't think that they totally want to give up that this market can be higher on the soybeans yet.
All right. I just thought with the big Brazil crop coming, I've been surprised that we've been able to hold together here. All right. Thanks for joining us, Scott Varilek with Kooma Varilek, and that's Markets Now.